Hey everybody, welcome to Korean Atlanta Mentorship here with another video. So we've covered this several times, but I'm just going to keep covering it again because a lot of people have a lot of interest in this topic, which is the government, the state of Illinois, Department of Financial and Professional Regulation, Division of Banking, going against Novo Elite and Accelerated Strategies LLC. And if you don't know who those companies are, basically it's companies owned by the Kwok brothers. And if you don't know who the Kwok brothers are, let me just type Kwok brothers. They're big YouTubers, 346,000 followers. And you'll notice on their YouTube channel, you don't see the words velocity banking or accelerated banking anymore because the state government, state of Illinois, Department of Financial Professional Regulation, Division of Banking, sent a cease and desist letter to the Kwok brothers saying, hey, you are not allowed to use the words bank, banker, or banking in connection with the business without prior approval of the division, right? And so this is why we actually don't offer any velocity banking services. If you go ahead and click any of the links, we say if you're interested in velocity banking or any sort of consulting, go away. But anyways, we are content creators, so we do demonstrate that. But they went down on the Kwok brothers with civil action, and so basically saying, hey, you use the word accelerated banking, and therefore we're going to fine you $20,000, right? You used the word so accelerated banking using the words bank, banker, or banking, whether as a legal name, assumed name, trade name, brand name, or DBA, and you can't use accelerated banking or velocity banking or any other term using the words bank, banker, or banking to describe or promote any aspect of Respond's financial education or consulting services. See, we don't provide consulting services. I will tell you very quickly that I try to recruit members into my cult, but that's not illegal as long as the cult isn't doing anything illegal. And until responds requests and receive written approval from the division or becomes licensed or authorized to engage in the business of banking under the laws of any state or of the United States. And you know what's ironic is that if you're a bank, the last thing you actually want to promote is accelerated banking or velocity banking. Isn't that ironic? Like, if you're a bank, this is the last thing you'd want to promote because all your loans and credit cards would be paid off too quickly. But yeah, so that's pretty much it. I mean, what can you say? They don't like it. So can we say that, hey, the state government actually hates the words velocity banking because it contains the words banking and you're not a bank? The only thing that would probably similar to this in my mind is if you had a group called Restaurant Consultants Group LLC, and then like the Department of Health got on your case because it's like you use the word restaurant and you're not a restaurant. Now I don't know the legality of all of this because obviously I'm not a lawyer, but I'm just kind of doing some analysis, even though I'm not a lawyer. And if you need legal advice, talk to a lawyer, right? But yeah, that's pretty much where we're at today. In fact, I've been doing some demonstrations with alternative names, and I got this comment right here. Can we choose a simpler name instead of the velocity debt cannonball method? That's a mouthful and doesn't really fit the description that well. Maybe velocity payoff strategy method. And so what it seems like is that the people are demanding a better name than the name that I came up with because I was just like, whatever, I'll call it something. And then so I took inspiration from the artist formerly known as Prince. And I just said, why don't we just call it something really long? And I actually adopted this from another commenter, which is the velocity debt cannonball method. We can't call it velocity banking anymore, boys and girls. It's the artist formerly known as Prince. We can't just call it Prince. It's the method formerly known as velocity banking, aka the velocity debt cannonball method. And so, yeah, maybe I will come up with a better name for this, right? You know, just don't use the words banking in the strategy, you know. That's why they probably use the words accelerated strategies in their name. And then if you actually go to the Kwok Brothers channel, right, and let's just quickly explore, it will be put your entire paycheck into the HELOC strategy. You don't see the words banking anywhere, right? You don't see HELOC to pay off mortgage. Why does it work? A HELOC calculator, right? And then yada yada yada. So Yada yada. That's a Seinfeld thing. So, anyways, yeah. So, can we infer that the state government hates this velocity banking strategy? Well, I don't know if they hate the strategy, but they certainly seem to hate the words, right? And I don't know. Does any government entity have any feelings, or is it all procedural and bureaucratic? I don't know. All right, so let's go ahead and get started with another debt payoff session, right? Um, so I'm just staring at this and thinking, what's a good name? Because this is, I do agree, this is overly long. The artist formerly known as velocity banking, aka the velocity debt cannonball method, that's just way too long, folks. But this is what we're going to, regardless of what the name is, we're just going to go ahead and pay off debt using this method compared to the average American method, right? So what we're going to do is we're just going to, first step is to create a budget, right? So this is a debt payoff strategy where you have your income, your expenses, and you have your leftover checking and savings, and then you create an expense breakdown. And then in the expense breakdown, you have to list every single debt that you have, right? Every single debt as its own line item. So you have 5 credit cards here, an auto loan, a student loan, a mortgage, and then you have your personal expenses like food, gas, insurance. So things that you would always have to pay for even if you had no debt, right? So our goal is to get rid of all of the debt so that we increase our cash flow and to minimize, what goes to the bank in the form of interest. But we always have to pay this every single month, right? And so what we're going to do with this method that's overly long, the artist formerly known as Prince Velocity Banking, aka Velocity Debt Cannonball method, is we basically say, hey, you know what? With the same income, all right, the same income and the same expenses, and let me go ahead and copy and paste this, all right? Copy and paste. I think this image here is kind of making things slow, so let me delete it. We're going to do something a little bit crazy that most people won't know how to fully process, right? So what are we doing is we're doing the opposite of Dave Ramsey's step one, which is saving $1,000. So think about this right here. You have $70 in your checking and savings, and you're following the Dave Ramsey method to pay off debt. How long will it really take to save $1,000? It's going to probably take a long time. And it's going to probably be hard because it's hard to keep track of all of these debts, right? It's really hard to keep track of all of it. And we're trying to make it as easy as possible. And one of the ways that we make it as easy as possible is just to make sure that we put all of our money into one place, which means that we're going to not save money and we're going to put it in something called a line of credit, right? So if you don't know what a line of credit is, it's basically a financial tool where you could borrow money, pay it back, and then use it over and over again. And we're going to go over that soon here in just a few minutes. But before we go into that, one of the things I want to talk about is the cash flow index. So if you don't know what that is, it's just a basic formula of the balance of your debt divided by the payment. Do that with every single one of your debts, and what is it going to do? It's going to give you a debt ranking payoff system, right? So basically, it's going to order debts from smallest to largest, or not smallest to largest in balance, but in terms of bang for your buck of which debts to pay off. So these low numbers, what do these mean? Basically means you're going to get a lot of bang for your buck for paying off the debt, whereas this high number is basically saying, hey, if you pay this off, you're not going to get that much cash flow, right? Literally have to give someone $300,000 on this mortgage to get $1,400 back in my cash flow, right? Whereas with these credit cards, if I just pay this one and this one off, 45,000, right? I literally get the same, pretty much almost even more cash flow than this $300,000 mortgage. So it makes sense for me to pay 45,000 for this cash flow rather than 300,000, right? So it's all about ratios. It's all about bang for your buck. Now the next step is we're going to assume that we have a line of credit. So what's a line of credit? It's basically a financial tool where you can borrow money, pay back, and then use it over and over again, right? So there's home equity lines of credit, there's personal lines of credit, business lines of credit if you're doing this with the business. And so with a line of credit, you have the tool of ultimate flexibility and you can use it to transfer debt, right? Because we do lots of sweeps and debt transfers. And what we're going to do is when we get paid is move all our money into line of credit, so we're always attacking the debt. And one of the reasons why this is so easy is because our all of our money just essentially just goes to one place, and that's it, into the line of credit. And I'll show you what I mean by that. So what we do is we move the appropriate debts into the line of credit, increase cash flow, and then we'll just put our paycheck into the line of credit. So I'll just show you how that works. So what we're going to do is 5, 8, 15, 27, 30. So we're going to take these low cash flow index numbers, right? Sum them up, and then that's $85,000 of credit card debt. So let's move this $85,000 into the line of credit. Now, here's the thing, and this is what we have to understand about banks. If we only have $70 left over because we have all this debt, right? Look at our expenses. We're making good income, but we have tons of expenses, tons of debt. What we have to understand is that banks don't lend money to people who need it. So this is like the bank's what I would call institutional psychology. Okay, every institution has its own psychology, whether it's government, banks, whatever. Right? There's certain things that they want to see and certain things that they don't want to see. With the bank, they don't like to see people who need money because people who need money don't pay you back. That's what they learned from their collective experience over many, many years. Okay. So, what they're looking for is a person who doesn't need money, lend to them, and then once they have too many debts, that's when they're like, we're not lending you any money, right? So that's why when your credit cards, like personal credit cards, are maxed out, they don't want to lend to you anymore because you need money. But when you have like 10 credit cards and you make good income and you don't have any debts, that's when they think, whoa, this is the perfect candidate to loan money because he doesn't need it, right? And the way that you have to think of a bank is the opposite of what their marketing tells you. Okay, so their marketing tells you we'll be there for you when you need us, which is completely not true. They'll run away from you when you need them and when you need money. Okay, so you have to think of them as a vampire. Vampires only look for people with blood. When you have your blood drained by other banks, aka other vampires, there's no blood for the next bank to suck off of, right? There's no blood, right? So when they see this and they give you another debt, they're really thinking we're not going to get the blood, aka the interest that we need in order for us to survive. That's what the bank is thinking. Now, why do we demonstrate this with the free and clear line of credit? Okay. Well, I'll show you why we demonstrate with this line of free and clear line of credit. It's because if you'd known this strategy from the very beginning, you'd probably never be here. Okay? That's why. It's kind of like, hey, what if, and I hate to say this and I hate to laugh about this, you knew how to make the cure to whatever disease that you had, but you just have to. Actually, you know what? Maybe it's more like, hey, what if you'd never gotten sick? And I'd show you how you would never get sick. You know, maybe it's something like that. But yeah, so the reason why we show it like this is because it's really easy to show the benefits of this strategy if you've known this from the beginning, not when you're struggling with $70 left over, right? And if you want a real life case scenario, join the YouTube channel membership, 99 cents. And we have in that membership a live stream where someone sent me like $5,000 of income a month, 22 debts, and like $4 left over. And in that real life case scenario, what would happen is someone would have a line of credit, but it's maxed out already, kind of like a maxed out credit card, right? So the difference between us when we use this really long method name, and I need to come up with a more serious name, is that we're going to put our paycheck into that line of credit, take our expenses out, and rinse and repeat over and over again. Now, here's the crazy thing when we move this $85,000 credit card balance, I'm going to show you here, is that when we do a debt transfer, we're not, you know, making more income. There's no expenses that have been reduced, right? It's the same expenses, but these all go to zero, right? And so magically, this $70 turns to $2,898.13. Okay. And so what we're going to do is now do the final step, which is we're going to put the paycheck into the line of credit, the 9,000. It doesn't matter if you're paid weekly, bi-weekly, whatever, that 9,000 into the line of credit, take our expenses out appropriately when we need to pay these other expenses, and then rinse and repeat over and over again, right? So how do we calculate this with Excel, pretty much we can estimate it with taking the previous month's balance interest minus a cash flow, so 2898.13, right? You see how easy that is? Oh my goodness, it's so easy. And then what we do is we need to take the average daily balance, right? Take this, multiply by the interest rate, which is 0.08, and then you divide by 12. And then what you're going to do is copy and paste and see how long it takes for us to pay off the debt. And you see that after every single month, the balance of the debt goes down about $2,800 plus some interest, right? So let me just kind of go down here and let me go down here. And then we see that in month 33, right? Month 33, and I kind of already did this before. You ever hear that the Bruce Lee saying about, hey, do this one thing like 10,000 times and then you'll be like really good at it? I just do the same thing over and over again. But 33 months, we pay it off. Okay, so we pay it off, and we just mark here how long it took us to pay off the credit card debt. So 33 months, and then this is going to be 85K, right? So 85,000, and it took us 33 months, and so we literally went from $70 to $2,898. Not at the 33 month mark, at month zero if we were able to get a free and clear line of credit, but we probably won't because banks don't lend money to people who need it. Remember that, okay? So now we have three more loans, okay? Student loan, auto loan, and mortgage. And we say $200,000 loan just because, like, hey, a lot of professional careers out there where you're making good money, but you need to get that $200,000 loan. That's really scary, right? So let's go ahead and just get our loan calculator. So what we do is we just use this amortized loan calculator to figure out what the current balances are based on the month, right? And we see we have the cash flow indexes here. So what we're going to do is take the current balance, right, of that auto loan with the lowest cash flow index, move it into the line of credit, and then get that extra cash flow. So let's go ahead and do that. So I'm going to just do this right here, okay, and then I'm going to move it. So plus 11714.43. And then what we're going to do is we're going to put 0 on the auto loan, right? 0 on the auto loan because we just transferred the debt and now we've increased that cash flow. So let's go ahead and do that right here. And then I'm just going to go ahead and copy and paste, and then minus 3347.34. Okay. All right. So now we see that in 37 months, that auto loan's been paid off, right? So 37 months, we're credit card and auto loan free. And then this is going to be 85 plus 25, so that's going to be 110K, all right, 110K, paid off debt. And then we have the student loan and the mortgage, so let me just kind of go here. So now I'm just going to put 0 here, 37, 37. So right now, our line of credit is about $100,000. But does this mean that we should put every loan into a line of credit? No. No, right? Because if you know anything about the cash flow index, it talks about efficiency and inefficient. So basically, any loan over 100 is considered to be an efficient loan, meaning that if you pay it off, you're not getting that much cash flow. Meaning you got a lot of balance and very little cash flow, right? Whereas between 50 and 100 is like, it's okay if you pay it off, but you got to be a little bit careful. And so here's what you have to also know about efficient loans is that if you actually just make the minimum payment or the monthly payment up to the full term, so let's say 360, you end up paying a lot of interest even at a low interest rate. So $300,000 30-year 4% mortgage at the end of the term with 360 months is 30 years. Look how much interest you pay. So it is important to pay it off, but we got to pay it off in the right order. So we're going to pay this one off first, which has a lower cash flow index, and then we apply the cash flow from this loan to the next loan, right? So there's two ways we can do this, and a lot of people say, "Oh, don't put extra payments into the loan, extra payments," right? So meaning you make the minimum payments for here and here, and then put the $3,374.34 into here, which we can do. And let me tell you something: a lot of people can't do this because um, they make that extra payment and it feels like you've given away all of your money to the bank in that form of extra payment, which is real because like let's say you overpay a credit card or you overpay let's say a loan. A lot of people think they can't make more than minimum payments because like, well, if I need more money, what do I do, right? but you just get the money from the line of credit. Now you could actually just use your credit cards and your line of credit as a backup, but one of the reasons why you might want to do this thing that I call chunking is that you don't want to segregate your income. And income segregation is how you got here in the first place. So what I mean by that, basically you get paid, your pay gets split, in 20 different ways. In this case, it would be like, I think, eight. And then you put the leftover checking and savings, right? So what we're going to do is always put our money into one place, aka the line of credit. Okay. And then so that will prevent segregation of income. And what we can do with these loans is we could just put a chunk of the loan into the line of credit. Now, the only reason you do this is if you have a cash flow index that's relatively high. And there's a big difference between the interest rate or a difference between the interest rate and the line of credit. So line of credit interest rates at the cheapest are probably like 7-8%, right? Probably 8%. And at the most expensive is probably 18%. So you'll never see like a 3% line of credit unless it's some sort of a promotion, right? So let me just go ahead and show you how this works. So basically what we're going to do is just put the, let's say $9,000 of the loan into the line of credit. And let me just kind of demonstrate this quickly. So we just have to put the loan factors right here. So this is going to be 10-year and 6% payment amount is 1432.25. 32.25. Actually, is that the right one? No, 2220.41. So 2220.41. $200,000 student loan, and then the current balance is 150,533.38. So 150,533.38, and now I just got to make sure all the other things are good. So what are the actual expenses? The expenses is, let me see right here. It's these two. It's everything except for the loan you're trying to pay off. And we're going to go ahead and sum it up. So that'll be 3432.25. So let's just do this right here. So 3432.25. Okay, 3432.25. And then we see that it gets paid off in about 2.5 years. So what we're doing is moving $9,000 of the loan into the line of credit and just dumping all of our money into the line of credit, right? So that's essentially what chunking is. So let me just kind of do this right here. So 2.5 years, and let me go ahead, and then there's going to be 0. So here's the thing, and the reason I talk about this is that a lot of people are afraid of that higher interest rate. Yes, if you just never like only make that interest only payment, of course that HELOC or line of credit will kill you, right? But if you have the cash flow and you're paying off the debt in the right order, then it shouldn't be an issue. Okay. So now what are we doing here? This is 2.5 years. So what we got to do is this is going to be 0 now, and then be 37 plus 2.5 times 12. That's going to be 67 months. Okay. 67 months. We paid off 310K. And look at me just saying, so just casually saying, oh, it got paid off relatively quickly. All right, and then what we're going to do here is the mortgage. So in 67 months, what's the balance of the mortgage? It's going to be 67 right here. And then, so it's 267, so we just got to put the same thing. So what's our expenses? Everything except for the loan we're trying to pay off. So that'll be $2,000. So let me just kind of put this right here. $2,000. And then let me kind of go here. So 30, what's the interest rate? Interest rate at what is it, 4%, and we probably got this loan in the early 2020s. 300,000. Okay, and the current balance is 267,610.99. So 267,610.99, and then the payment amount is 1432.25. So 1432.25, and then we see that mortgage gets paid off in about 3.5 years. So what I have to do is just add 3.5 years here. So this is going to be 0, and this is going to be 67 divided by 12 plus 3.5, and then 9.808 years debt free, right? And so that'll be 610K. Net worth is at least $300,000 because if we have a paid off mortgage, that mortgage is an asset. So we have at least $300,000 net worth, and then we can just probably build our net worth, maybe investing in real estate. Okay, well, that's it for today, folks. Creative to Mentorship here with another video of something known as the artist formerly known as Prince Velocity Banking, aka Velocity Debt Cannonball Method. Um, and notice that they're still, I think they're still offering the service, right? They're still offering the service, but you don't see the word banking anywhere here. It's because the state government of Illinois is like, can't use that word. So we got to come up with a new word, folks. And we've already gotten feedback from YouTube that the name, the Velocity Debt Cannonball Method, is way too long. So I probably, you know what? Maybe we still call it Velocity something, Velocity Strategies, Velocity something, um, Velocity Debt Payoff. I like that one. I think that's a good one. Velocity Debt Payoff Method. Yeah, I think that's one. Just can't call it Velocity Banking, folks. All right. Well, have a great day, everybody. I'll see you all next videos. Korean Latin Mentorship.